right at the core of what drove markets this year and what will continue to drive markets this year, and in particular, what's happening to inflation and how central banks will interpret it. So inflation, as we come through 2020, I think it is coming back down, and I think it's going to sort of come back down quicker than a lot of people expect. And so when you look at it, and even if I look at the U.S. Sort of headline inflation in the U.S., if you look just the past 6 months since it started coming down, assuming that the December number comes out as expected, headline CPI in the U.S. is currently running at just 2.3% over the past 6-month period. So already substantially down from those 8, 9, 10% periods. So the big surprise was how quickly we ramped up on inflation, aggravated by energy and food. And I think there's a surprise as those fall out of the numbers, then that we could see that inflation collapse much quicker. We're already seeing deflation in the goods side. That's kind of that supply chain issue driven things. Cars are coming on lots, inventories building up, discounting. We got deflation in the goods sector. Energy, we're not at 120 oil anymore, coming down, continuing to be disinflationary as well. And hopefully food should follow that down as well. So those components, very cyclical, should start actually contributing to more disinflation as we go through this year. And then the real catch-all, the one that people are going to care about, or central banks are going to care about, it's going to be the labor market. What's happening to wage inflation? This is more important than all the rest. So we could see very much weaker overall numbers, but if I don't see weaker labor market or wage data, then I think central banks are going to be more biased to saying tighter than otherwise.